welcome to another episode of Property Matters. I'm Steve Hughes, and this episode is brought to you by the Fountain Group, a London-based property management specialist offering residential, block, and commercial property management solutions. We're joined today by Christopher Coleridge Cole from Gresham Street Partners, and we're talking about a very, very important topic. We're talking about property tax and how Chris's solution is providing landlords with a way of massively reducing their tax liability. So welcome, Chris. How are you doing today?
Well, good. Good to speak to you. Looking forward to explaining the benefits of what our restructuring and incorporation provides.
I'm looking forward to hearing about them. Now, I'm sure the audience is. And because it's such a powerful topic, I'm going to ask you to share this with people that you know that might be relevant to. And in fact, if you're listening or watching this episode right now, don't forget to subscribe, like, and share. And if you would like to either appear or hear about topics in future episodes, make sure you get in touch with me at propertymatterspodcast@gmail.com. So kicking off, can you briefly introduce yourself and your expertise in property tax matters?
Thank you. Well, I'm by profession a trustee. For years, for some 40 years, I've given estate planning advice, all manners of tax advice, succession planning, inheritance tax planning, and setting up trusts. I am managing partner of Gresham Street Partners, and we are property tax advisors. We're a consultancy.
Okay.
We work with a very major firm of tax planning accountants.
Mhm.
I think they are the number 20, in the top 20 anyhow, of tax planning accountants in the country.
Brilliant. That's fantastic. Now, there's more than meets the eye when it comes to tax. Since moving to the UK, I've realized that it's almost a superpower if you fully understand the tax platform in the UK. But we're talking specifically around a change in legislation that happened recently called Section 24. Would you briefly explain to the viewers who might not know what Section 24 is? What exactly is it, and how does this impact property investors?
Section 24 was introduced by George Osborne. It's almost his parting shot. He wanted to try and reduce the property rise that was going on at the time. What he effectively has done is bankrupt thousands of landlords. It really was, he was trying to manipulate the market, and you cannot manipulate market forces. It was a shocking piece of legislation, but it has impacted landlords to the most horrendous extent. In a nutshell, he's effectively taken away tax relief against mortgage interest for landlords. So all of a sudden, if you're balancing the books, 1 minute you've got your outgoings and you've got your income.
Yes.
And all buy-to-let landlords have always tried to make sure that they equalize, and that the rental equals the outgoings. Well, Osborne effectively increased their debt, their liabilities by 90%. He reduced the deductible expenditure against mortgage interest by 80%. He did it over 4 years, but I mean, he still did it, and he reduced it by 80%. And he also took away something called the wear and tear, which was another 10%. Well, I would love someone to tell me how you run a business, any business in the world, where you suddenly lose your tax deductibility of your expenses, or put another way, your outgoings go up by 90%.
It makes no sense. In South Africa, in any business, your expenditure in the running of the business is a tax deduction. Here now, when it comes down to property, it almost feels like that's a nail in the coffin to property investment.
Well, that was made worse, of course, by Mrs. Truss when she had her brief exposure to market forces, when she and Kwasi Kwarteng decided to literally push up the expenditure of landlords by 250%. That was the final nail in the coffin. They are up the proverbial creek without any form of a paddle. There is a solution, however.
Okay.
We'll get to that, I'm sure.
Absolutely. Are there any other factors that have negatively impacted the property landlords other than Section 24 tax?
Well, yeah, trust and quality,
Okay.
massively. And also what's happening to them now about the controlling of the rent. I mean, what they are facing now, what he's going through now with his current government, they are being absolutely mullered. I mean, it's quite interesting to see the effect of this. To put it into perspective, I've been going around saying that since Osborne, landlords are selling up between 40 and 45% of their property portfolios. I've said this for the last 4 or 5 years, and most lettings agents and insurance brokers with property divisions would agree. After Mrs. Truss, it went up to 60%, based on what I just said earlier. And I was very reliably informed by a major sort of publication in the buy-to-let world, that the figure is now, as of last month, 74%. Nearly 3/4 of all landlords are selling up or selling some of them. If you had looked, and I have various paper cuttings which I take out of publications like the Sunday Times and Saturday Telegraph, have very good property pages. There are 2 articles in the Sunday Times in the last 2 months outlining what I've just said. And the most recent was on Coronation Saturday in the Saturday Telegraph, where the lead story in the property pages was British landlords selling up. It's shocking, and it's got to be stopped.
Is this not the same government that has been declaring that there's such a problem of housing shortage? They're creating the problem that they're moaning about.
Yeah, of course it is. I mean, that's why you are reading in every single paper you read, if you listen to BBC Breakfast or whatever, they're saying, what, every other day there's some article about the fact there aren't any rental properties to rent and the prices are so high. Well, why on earth do they think that?
It beggars belief, it really does. Are there any strategies or methods that property investors can use to reduce the impact of the Section 24 changes?
Yes, there is a solution, but it comes at a price. And then there's another solution, which is where we come in.
Uh-huh.
So the solution is, for going forward, for anyone ever buying property to rent, buy it through a company. To me, it is a no-brainer. There are some mitigating factors that people will throw up, but to me, running your properties through a business legally, openly, declaring what you do as a business through a company is the obvious way of doing it. Regarding the situation where landlords have got properties already, that is a really very serious.
Yes.
You can't, obviously, well, you can, and lots of people have done, sadly, but you shouldn't really transfer your properties directly into a company, because if you do, you'll end up paying more stamp duty,
Yes.
and you'll create what's called a chargeable event. Now, in this case, it's a liability to capital gains.
Yes, I was about to say, it's a capital gains tax event.
So,
Okay.
you will end up paying a lot of money to move your properties directly into a corporate.
Hmm.
That's where we come in.
Okay.
Now, there are 2 ways of doing this. There's what I call the Mini Cooper way, and there's a Rolls Royce way.
Oh, fair enough.
We, of course, go the Rolls Royce way, although the accountants I use do the cheaper version and the quicker version, but only for people. Forgive me for saying it like this, but it's the only way I know of saying it. For people who are poor, who are desperate, who are in a point at a junction in their life where they are nearly facing foreclosure by the banks, where maybe they haven't got a great capital gain, but they cannot afford to keep going. They have got to get out of their own name into a company to reduce the income tax, because obviously, if they're paying top rate tax or higher rate tax per person, that's a nightmare. If they can get it into a company, well, then you're paying between 19 and 24%. But, you know, right now, the Section 162, which is the Mini Cooper version, is, quite frankly, only for people who don't have a capital gains tax liability, because whilst they get them into a company, and they get them in the company really quite quickly, probably within 3 to 5 months.
Okay.
And it's not that expensive. It's probably going to cost them somewhere in the region of maybe 8 to 10, 11,000 pounds. Whilst they can do that quickly, and it gets around stamp duty, it does not get around CGT.
Ah.
It seems to me pretty foolish, if you have a CGT tax liability, to defer it, because that's what Section 162 does. It defers CGT,
Fair enough.
but you're deferring it on an asset which is going to go up in time,
Yes.
so your debt's going to grow, and I'm sure we're going to come on to it in a minute, you're deferring it to a tax which is probably going to be doubling.
Okay. All right. So for those who don't know, what is capital gains tax and how does it get factored in?
Capital gains tax is what it says on the tin. It's a tax on your capital gain. So if you have owned the property from 5 years ago and you're now selling it 5 years later, that gain minus the allowance that you have is taxable. Now, capital gains tax is 20% for normal equities and other assets. For property, it's 28%.
Okay.
If Labour get in, and I say that with tongue in cheek because, quite frankly, it's perfectly obvious to me, Labour are going to roll in.
Mm.
They have made it perfectly plain that they are going to be increasing income tax. I've heard it said by the likes of Mrs. Rayner and others that it's likely to be, top rate tax is likely to be going up to 55 or 60%.
Wow.
What is also very evident, and I have heard this said many a time, not least by Chair Starmer himself, Rayner, and also Frances O'Grady, Baroness Frances O'Grady, who is head of the trade union council, Congress, whatever they call it. She said to Laura Kuenssberg very firmly, well, when she was asked how they're going to pay for all the taxes or the money they're going to give to the nurses, she said, well, of course, we'll be taking up capital gains tax to run parallel with top rate tax. That means, quite simply, for people with equity portfolios, it's going to treble.
Wow.
And for people with property portfolios, it's going to double. So why use Section 162 when you're deferring the tax on an asset that's getting bigger to a tax that's going to grow infinitesimally? Makes no sense at all.
So it doesn't make sense to go the mini route.
No.
So Rolls-Royce it is. What are some effective strategies for minimizing CGT liabilities when one is selling investment properties?
Go our route.
Okay, simple as that. So get in touch with you for that. And are there any exemptions or reliefs available for property investors to reduce their CGT obligations?
Yeah, through restructuring.
Okay.
By that I mean we have, as they call it, the Rolls-Royce route. It's a longer version of the 162. But at the end of the day, what we do, and I'll explain what we do in a moment, but at the end of the day, what we achieve is we get the client and his properties into a new company. I call it NewCo for want of explaining, without any additional stamp duty, without any CGT being levied. That's basically what we were briefed to do, but we achieve an awful lot more because we have three other major benefits that we achieve by our restructuring. We effectively rebase the value of the properties,
Okay.
and in so doing, we get rid of all previous capital gains tax.
So you reset the value at whatever the transfer value would then be, not the
Whatever the value of the property is going into the new company are,
wow.
that is, if you want, where they are rebased.
Brilliant.
That's one benefit. The next benefit is particularly prevalent to my experience and my expertise as a trustee. I have experience and have a lot of experience in inheritance tax planning.
Mhm.
And we have an opportunity at the point of moving the properties into the new co, literally on the day that we do it, of, if the client wants, taking those property assets out of his estate for IHT purposes. And then the last benefit is the one I love talking about most, because it is the one that people don't really understand until I've explained it. But then when they do understand how it achieves what it does, it is very mind-blowing, especially to landlords who own property in companies already, in SPVs already.
Yes.
We can talk about that a bit later, but this is particularly appealing to them, because in our restructuring and incorporating the properties into the new company, we are able to help the landlord extract from the new co his entire net asset value. In other words, if you want his equity
Yeah.
out of that company completely free of tax. We
Amazing.
effectively create, as the accountants I work with call it, a tax-free IOU
Amazing.
because of the way the properties have gone into the company.
So whether you are whether you own property in your own name or it's already incorporated into a business, there are benefits available through your model.
Yes.
Brilliant. What are the key factors that property investors should keep in mind when deciding between properties individually owned or properties within a limited company?
When you say key factors, I think there's only one solution to it all, and that is to get on and do it before Labour get in.
Yeah.
You know, at the moment, and I'm always asked this, what we're doing is not a scheme. It is not in any way dotastable. That's an expression to deal with schemes that need reporting back to the revenue. This is not a scheme. We are using three pieces of legislation.
Mhm.
The right of the LLP to have property assets, the right of an insolvency practitioner to be able to transfer, to close down solvent entity and move solvent assets into a new receiving solvent entity. That's what they do. That's what an insolvency practitioner does day in, day out.
Mm.
It's called an MVL, a Members Voluntary Liquidation Procedure. And that's the law. So that's stage two. And then stage three, quite simply, is the right of a company to own property. I mean, if that wasn't legal, you'd have the whole of the city of London. In fact, you have most cities in the country with problems because most properties are owned by corporates. So we are simply using the law as it exists.
And knowledge of the law to an extent where you can integrate different laws together to provide a holistic solution is really what it's a smart way of staying within the legal elements of financial mastery, really.
And of course, giving proper tax planning advice. That's all we are doing.
Perfect. How can property investors leverage their portfolio then to maximize tax advantages?
Um, Only really if they are clearly running their business as a retirement form.
Okay.
The revenue are not interested in allowing accidental landlords to be party to what we do.
Sure.
An accidental landlord is quite simply a couple who get together, they buy a house, they've got a flat each, and they say, oh, wouldn't it be a good idea to let this?
Yes.
Well, fine, let it out, but you're not going to, we will not be interested in that. We will not consider doing that. The absolute minimum that we will entertain is a portfolio of 3 properties, because the revenue want to know that we are setting up a proper business and helping a client run a property portfolio that he's owned so far as a proper business and taking it through to retirement. That they need to take place because, as I said right at the beginning, there's not going to be any properties around. We've got 3/4 of them being sold at the moment.
Mm.
If we don't do what we can do, if landlords don't get their head out of the sand and realize they have got to take steps to deal with this, there won't be any buy-to-let properties on the market. No wonder the press are leaping up and down saying how much it's costing
Mm. Mm.
and how short there is, how little property there is available to rent.
Okay. And so your model is really working for people who are looking at a legacy portfolio and have more than just the one tenanted property. Is that
Yes,
right?
absolutely.
Okay. Um, what are the implications of different ownership structures? So, for example, joint ownership partners on property tax obligations.
One part of our structure does need there to be 2 partners. So whether you are husband and wife, 2 mates who've got a business, and some of my landlords, I have a very big business down in Brighton, and some of my landlords down there have 4, 5, 6 companies that they run with other landlords as partners. They'll go into a series of deals and they'll build up their own portfolios between the 2 of them. So providing you've got 2 individuals as partners working through this procedure that we adopt, it can be anyone. It can be a man, head of the family, doing it with his son or daughter, and it can be 2 siblings, and it can be the wife and the husband.
Okay. And obviously, the answer to this next question is to get in touch with you immediately, without any delay. But besides your solution, can you provide any other practical tips or advice for property investors so that they can stay organized and effectively manage their tax obligations?
Do as we say. Genuinely set up an LLP, limited liability partnership, and run the business, your property business, as a genuine property business, not, as I said earlier, fringing on being an accidental landlord. The revenue need these businesses to grow. We can help them grow. We have a tagline which says, we help landlords stay solvent and not go bust. That to me is what I wake up thinking about every single day. And if landlords can realize that if they get into this restructuring and incorporating procedure that we operate, they will be able to keep their properties going. They will be incredibly tax efficient and cost efficient. They'll be able to go on buying more.
Well, that's the whole point. Is you listed the benefits of your strategy for both private ownership and incorporated property ownership. But from what you told me of your benefits, it's quite possibly a rocket launch of financial liquidity to grow a property portfolio out of being a smaller portfolio into a far more healthy portfolio.
Yeah.
The recapitalization of your equity, that's allowing a structure to have more funds to purchase property, which will, if the landlords are getting out of their property businesses, going to drive the sale price down of properties. It really is the ideal time right now using your strategy to go from a small portfolio to a very large portfolio.
You know, it's interesting you say that. It's interesting to bring in the banks and the lenders into the conversation at this point, because when this all started, you know, the banks and the lenders and the mortgage companies were trying to sort of charge all sorts of administrative fees and be a bit greedy. Um, in the last year in particular, the major lenders, you know, the banks like Barclays, Lloyds, Handelsbanken, they've all come round to understanding what we're doing and to understanding that this really is helping their clients.
Mm.
I once had to go to I won't mention the bank, but it was quite a major bank, with the accountants, and we had a meeting with the board, and we were trying to explain to them what we were doing. This is quite early on, about sort of 6 years ago. And when they started to get rather antsy about the whole thing, I just turned around to them and said, listen, wouldn't you rather have a happy client who is grateful to you, who you have kept solvent, who you have allowed to restructure, incorporate? He's now paying far less tax, he's buying more properties, and he's going around saying XYZ Bank are bloody marvellous, and I would go to them and I'll give you the banker's name. Or would you rather them turn around and say, you're a load of shysters? And I said, I added also into the equation, and by the way, I will go into social media and print and tell them what shysters you are. Believe me, if you're going to screw up my clients
Yeah.
and try and stop them running their business in a tax efficient way, I'll go public with it.
Yeah. I'm glad you
And
did that.
and they turned around and they got the point. I said, wouldn't you like a happy client who recommends you and buys more than someone you make go bankrupt?
You'd think that'd be logic, but sadly.
Well, it took a while, but now they are actually they're playing the right game. They're on the same page, and they are actually being very helpful.
I found that even though the interest rates are increasing, your mortgage rates are actually dropping. I've noticed that over the last week.
Yeah, I think yes. I don't think the two are necessarily that compatible the whole time.
Mm.
You know, I think that was obvious because it had all gone up so much. I'm afraid to go back to an old chestnut, courtesy of Mrs. Truss. Um, um, I think her idea, funnily enough, was right, but I think the way she did it was completely skewballed.
Mm.
And you know, I've heard that Kwasi really didn't want her to do it, and she just went galloping ahead. And you know, undoubtedly, it was so misgiven and so misjudged, and it's had this dreadful effect on my particular marketplace.
Yeah. Are there any potential risks or pitfalls that property investors should be mindful of when implementing tax strategies?
Yeah, talk to a good tax planning accountant. You know, the firm I work with are utterly brilliant, and they are a very, very solid, proper, all-round, full-service accountancy practice. But they are the leaders in this field, and they will help you navigate, as you put it, all the issues. And what we do is we actually have something which is pretty unique to us. We call it a tax analysis report. We have a questionnaire we send out. We do it for masses of accountants and masses of lawyers, but we send because it's free. We don't charge for it. And quite simply, it's a two-page questionnaire, very simple questions about the individuals, and then um, a questionnaire about the properties. We then do this report, and it tells the client exactly what we're saving them to the penny in everything: income tax,
Amazing.
capital gains tax, inheritance tax, and also how much we get out of the company through the tax-free IOU. And that is so important to do that, to get that, to see that. And then we would then have a meeting with the client and hopefully his own accountants as well, and explain what needs to be done. But I will say one thing, which I think this question was really alluding to. Can anything go wrong to this?
Yes.
Only if you didn't get in before they stop it. Now, I don't think they are going to stop it. There's no reason why they should stop it. The revenue want us to keep this going. The revenue, the government, the country needs landlords to survive. And this is the only way they will do. So there's no reason for them to stop it. But when Corbyn looked like he was going to get in, we saw all sorts of QC tax advice on what the difficulties might be. Could they stop it if they were in an LLP? Could they stop it if they were in the restructuring point and going into the company? And the answer was no. Once you're in the LLP, they cannot turn around to you and tell you to take your portfolio out of the LLP.
Okay.
Otherwise, you'd have to tell every law firm and every accountancy firm to get rid of its office.
Absolutely, yeah.
You know, so the answer is surely get in before the horse bolts. Get in before any legislation comes in and prevents people doing it.
Okay.
And we always know if that's going to happen. There's always a consultative paper, and there is nothing out there at the moment, and no reason for there to be.
Okay.
Unless they want to completely destroy the rental market.
But let's be honest, when it comes down to reason, that's not something that's really applied by this government, is it? Certainly not logic.
No, if I was this government, thinking outside the box for a minute, I would actually introduce the increase to CGT.
Okay.
Because when we all thought that this might happen, I think there was a point where Richie Sunak was going to do it, and I think Boris Johnson stopped him. Because it's going to happen. Now, it's not a vote loser. The majority of this country do not like people with multiple properties. You know, there is a huge feeling of envy and jealousy.
They all wish they had multiple properties. They just don't like other people.
But they would like the tax that multiple landlords pay, but they would also like it if the landlord did have to pay the CGT. So I don't think it's a vote loser. Quite the reverse. I think it's going to win you the election. But if I was Richie, I would actually introduce it 6 months before the election, because you're going to get more people supporting you than the few meager landlords that are left who are going to be grimacing about it.
So Rishi, if you are watching or listening right now, just make sure you heard it here and take the credit where it's due. Are there common mistakes or misconceptions that property investors have regarding property tax matters?
Not sure what you mean. Can you elaborate?
Do you find that there are your prospective clients come to you and they have wild and crazy ideas or misconceptions with regards to property tax?
I think people think that everything falls under the same umbrella. So if you're talking about tax advice, well, let's think about all those dreadful schemes that were hovering around, a decade ago, in particular the film scheme. Now, I, as a trustee, and the people that I worked with went out of our way to advise against it. It was clearly a scheme to get round all manner of tax and capital taxes, income tax, and it was not bona fide. And it was, to me, perfectly obvious that this was counter Treasury disinterest.
Yes.
And of course, they reversed it. So As a result, anyone talking about tax, anyone talking about genuine bona fide tax planning, tends to get bracketed under the same umbrella. That's a bad analogy of using two analogies, but the fact of the matter is, a load of people think, oh, I don't like the idea of doing that. That might come back to bite us.
Mm.
Well, we've been doing this a long, long time, and we have had absolutely no issues because we work with the revenue, we tell them what we're doing, they are informed of everything, and there is absolutely no reason for them to ever challenge what we are doing because we are open about it.
In our first meeting, I mentioned a concept or financial model that I'd created back in South Africa that was arguably one of the most powerful financial solutions available. It was a similar structure in as far as I was integrating different legislative operators to provide something which 99% of financial advisors in South Africa were unaware of, let alone providing for their clients. And one of the biggest problems that I faced, and I'm sure that's something that you face, is this concept of it's too good to be true.
Yeah.
Even though it is 100% legal, it is ironclad, it has been checked, administered, gone to the highest court in the land, and this is the situation I was involved in South Africa, and it had passed with flying colors, and yet even then people would rather turn their nose up at in what it would be now is a 17-18% return on investment in the one platform. They'd rather go for a 7% return on investment because my model was too good to be true, even though there was legal precedent, a legal review stating that it is 100% above board. I'm sure that's what you face. People think this is too good to be true. And to be honest, these benefits are a no-brainer for anybody who's got more than, was it 3 properties of a portfolio greater in value of £1 million. If you're not doing this model, then you need to actually go and have your head ready.
Yes, thank you for saying that. I mean, I absolutely agree with every word you said. We've actually got, I think, 3 QC's opinions, and we've been to the top QCs in the land. I won't mention them publicly, but believe me, the last one was the head of a major chambers in the temple, and he is exceedingly knowledgeable, and they have confirmed that what we are doing is absolutely correct, and the way that we do it is, and the constraints that we put in it and the rules that we abide by are absolutely correct. And so I completely agree with that. Providing you don't try and cut corners. There are organizations out there trying to cut corners, trying to do it cheaply, trying to do it quickly. But at the end of the day, you get what you pay for, and we do it very, very thoroughly. And we have, you were asking me at the beginning whether I had any case studies. Yes, there are. We've done over 100 cases, but way over. But I have got 2 clients that I have talked to very gingerly, who would be happy to talk to any prospective client who was thinking of doing it and tell them how successful it's been for them and that it worked and that they went through it all, and what they say, what we said in our tax analysis report actually underplayed.
Wow. Okay.
And I have got 2 clients who I have only once, in both cases, introduced them to prospective clients. I have got in our tax analysis report that we put together an example of a real life case study.
Amazing.
But other than that, no, I think 2 is perfectly sufficient for anyone.
So if anybody was interested to find out more information, they could actually come to you and say, do you have a test tax analysis? And we could actually get real past client testimonials.
Yes.
Amazing. That's fantastic. Okay. Before we go on to how the viewers and listeners can get in touch with you, because they should right now be desperately clamoring for your contact details, just list again the benefits that property investors on both personal ownership or incorporated ownership can get through your model?
Right. For personal ownership, the immediate problem is to get their tax rate down from their top rate tax to corporation tax.
Okay.
Not only from a tax point of view, but so they can run their business as a business. They can run their petrol expenses. They can run the cost of running a business, everything that runs a business. They can offset all their their costs, their mortgages, which you can't now as an individual. So that's point one. That's what we get. We get about 3 introductions a day from various people.
Wow.
And the cries are, help me with my income tax. Second benefit, get rid of your capital gains tax liability that you have already. You know, get rid of it. Third, inheritance tax. If you are concerned about your beneficiaries paying IHT, I suspect that's going to go up also with Mrs. Rayner. I'm too certain that's going to go up. Although the Conservatives are calling Richie at the moment to abolish it. I think that's pointless. She'll bring it in immediately. But anyway, we can get rid of IHT in the property portfolio. And then the last one, which is a real one that landlords who own properties in SPVs and companies already love, we can help get the net asset value. In other words, the margin between gross ownership, gross value and debt, that margin there, your equity, we can get that out of the company completely free of tax. For the landlord that owns his properties already in a combination of SPVs, I just mentioned the big one. We can also protect against HT, of course, and we can also get rid of profits tax.
Okay.
So obviously we can't save him anything on income tax because he's already paying digits in that. He's happy as Larry, he thinks, but he's missing out massively.
So to sum up, you could take properties out of the personal name of a property investor, incorporate it, reset CGT, offset the need to pay CGT in the transfer, not having stamp duty as a factor. You're able to mitigate the Section 24 tax problem that was befalling them. And once incorporated, or if already incorporated, you can then gain access to the actual value that's left in the property to then further grow your property portfolio using that money that's now liquid.
Correct. Summed up brilliantly.
Thank you very much. So now I'm sure listeners and viewers are wanting to know how they can get in touch with you. I'm sure their fingers are poised over the keypad of their phone. How can they reach out to you?
Please don't go via LinkedIn. I hate the platform. It's the most nightmarish platform to actually work on. And of course, you can't send attachments. So when people say, really, why do I dislike it? Well, A, it wastes time, but B, you can't send attachments. Simple email, please, or my telephone. I have a mobile phone and it is on me the whole time, and I find it does save a lot of time. So mobile number is 07910 565 890. And my email is ccc, for my name, Christopher Coleridge Cole, ccc@greshamstreet.com.
Greshamstreet.com. And then the website, of course, then is greshamstreet.com?
Yes.
Okay, perfect. So that's ccc@greshamstreet.com and the website as well. I highly recommend you get in touch with Chris as soon as possible. My guest today, Christopher Coleridge Cole. Thank you very, very much.
Thank you so much indeed for your time and your interest.
You're very,
very much
welcome.
Very much appreciated.
And don't forget, when you do reach out to Christopher, that let him know where where you've actually heard about his model, and he can then send me flowers on as a thank you. Just to remind you that this episode was brought to you by the Fountain Group, a London-based property management specialist focusing on residential, block and commercial property management. For more information on them, visit thefountaingroup.com, and that's Fountain with an AYNE. So thefountaingroup.co.uk, thefountaingroup.co.uk. Got to get it right. From me, Steve Hughes, thank you very much. This has been another episode of Property Matters. Don't forget, if you would like to be a guest on the show or have topics discussed on the show, make sure you email me propertymatterspodcast@gmail.com. Until next time, thanks very much. Bye for now. For more information on Property Matters, on Steve Hughes, or on any of our guests, please email propertymatterspodcast@gmail.com.